Here is a quick video explaining the changes announced in the November 24 budget concerning stocks and shares. I'll firstly discuss ISAs. Despite all the excitement this year, there will sadly be no British ISA. This would have enabled investors to put an additional £5,000 a year of new money into UK shares. But sadly, that's just not going to happen due to mixed responses to the consultation launched in March of 2024. Now for ISA allowances. In a November 2024 budget, there were no changes to the amount you can invest into a stocks and shares ISA. This is currently set at £20,000 of new money in each tax year, but this amount is going to be frozen until the 5th of April 2030, and this applies to all other types of ISAs. For a stocks and shares or cash ISA, it's £20,000. For a lifetime ISA, it's £4,000. And for a junior ISA, it's £9,000 a year that can be added. You can hold several different types of ISA, but the maximum amount of new money you can contribute each tax year is £20,000 in total across all of them. The good news at least is that despite all the fear-mongering and speculation in the press recently about ISAs, there is no ISA cap, so there is currently no limit to the size of your portfolio inside an ISA. There was talk of this being reduced to as low as £500,000, and some sources even quoted £100,000. Good news also is that the amount you can put in each year is not going to be reduced anytime soon. The not so good news, of course, is that the annual allowances won't be rising either. From 2009 to 2016, the ISA allowance used to rise with inflation each year. But if the rate is frozen until 2030, that will be an incredible 14 years without change. Just think of the effect of inflation over that time. What seemed like a generous allowance in 2016 may seem a lot less valuable to savers and investors in 2030. And of course, if you fill your ISA and decide to invest outside of it, then there will be potential capital gains and dividend tax to pay also. And that's what I'm going to discuss next. I'll get straight into the big change for investors announced in the budget. Capital gains tax on shares held outside of an ISA is increasing. In the current tax year, basic rate taxpayers are taxed at 10%, and this is going to increase to 18% for the next tax year. Higher rate taxpayers are currently taxed at 20%, and this will be increasing to 24% in the next tax year. For those on additional rates, it will be the same as for the higher rates. You are only liable for capital gains tax when you sell some or all of your shares and therefore potentially realising an actual profit. And even then you won't have anything to pay if your profits do not exceed the yearly capital gains allowance. You also have no capital gains to pay if you realise any profits within a stocks and shares ISA. The following information refers to shares in a general investment account only. There is no change to the annual tax-free allowance. It still remains at £3,000. Let's assume you had bought some shares several years ago, which have now increased in price, and you decide to sell them for a profit of £15,000. Those in the basic tax bracket would potentially be liable for £1,200 once you have deducted the £3,000 and applied a tax rate of 10%. Next year, the same scenario would cost you £2,160 when a tax rate of 18% is applied. For higher rate taxpayers who sold shares and realised a £15,000 gain this year, they would need to stump up £2,400. And next year it will be £2,880 in our example. To reduce the tax bill, it's possible to offset losses against gains. Let's take an example and assume you are a high rate taxpayer and you want to sell Rolls-Royce shares, which have risen sharply for a £4,000 profit. Your current allowance is £3,000, so you will have to pay tax on the remainder above this amount. However, let's assume your shares in Croda have made a loss of £2,000 since purchase. If you sell all your Rolls-Royce and Croda shares, your net gain is £2,000. As this is below your allowance, you don't have to pay a penny in capital gains tax. Now for dividend tax held outside an ISA, and there were no changes in either the rate of the tax you pay or the dividend tax allowance, which remains at £500 before needing to pay tax. Let's take an example of someone receiving £5,000 of dividends in a general investment account. Someone on a basic tax rate pays 8.75% on any dividends above the £500. So on £5,000, that would be a tax bill of £394 to pay on your £5,000 of dividends for that year. If you automatically reinvest your dividends, it makes no difference. You still have to pay the same amount of tax as if they had been paid to you in cash. For higher rate taxpayers, the rate is 33.75%. giving you a tax bill of £1,519. And here is the amount you would have to pay if you are an additional rate taxpayer. For those of you who invest using private pensions, the budget did contain some rather unwelcome news regarding the future treatment of these for estate planning and inheritance, so you might want to do your own research on that if it's of particular importance to you. But for most of us, the budget didn't contain any really nasty surprises for those who invest using a stocks and shares ISA to shield investments from capital gains or dividend tax. This makes having a stocks and shares ISA even more important than ever to protect against tax, beat inflation and build long-term wealth. You can open a stocks and shares ISA with Trading 212 using the link in the video description, and they will give you a free share worth up to £100 to start you off. Please like and subscribe if you haven't already, and I'll see you in the next video.